Let's talk to Craig Erlam. He's a senior market analyst at Oanda. More importantly, a Liverpool fan, and they're playing my team this weekend. Morning to you, young Craig.
Good morning.
Right, dollar yen. You've sent a daily chart. Just to recap, Ichimoku clouds are very good to use in trending markets. And looking at this slide, we're basically below the cloud, which is negative for this currency pair. To recap, last few months, we've seen key support levels being broken. Why did you choose this pair today?
They're also particularly good as well on yen charts. A lot of Japanese traders, I believe, do use Ichimoku. It's obviously a Japanese trend indicator.
Does that mean it's self-fulfilling?
There is an element of that, I think, always with technical analysis. I think there is fundamental reasons as to why they work as well, but there's always going to be a self-fulfilling impact of it. Like you say, they're trends. So when we look back a little bit, we were chopping in and out of this cloud. That is normal in sideways trending markets. I don't think we can get too obsessed with that. But even then, you can see evidence of support and resistance along the way, so profit-taking levels and things like that. But we're quite clearly now below the chart. It looks like we've established more of a downtrend. We've broken long-term support. Now we're back in a zone here where markets are, where we are finding a little bit of support. We are losing a bit of momentum. Wondering if we're going to see a bit of a correction in this market, because the sell-off has been quite strong this year in this pair. Let's not forget we're up around the 114s, so to lose 10 big figures isn't insignificant. So if we do see a retracement back, then you're looking at the obvious levels again, the 107.40s, 108s. That's where we were finding support during that previous sideways trending moment. It also brings us back towards the cloud again. Now, the good thing about the cloud is it is a trending indicator, so it tells you whether you're in a bullish or a bearish trend immediately when looking at the chart. It also acts as support and resistance when you're above or below the cloud, typically, so that's another good sign for this particular chart as well. I've not included the lagging line on this chart because it's not quite relevant at this moment in time. You're looking at this for breakout confirmations. We're not at that point at this moment in time. You can't see on this chart because I didn't want to clutter it too much. There's also a couple of moving averages as well, the 55.89, which coincide nicely with the cloud if we do move back as well. So there should be, I would expect there to be plenty of resistance if we do move back at those levels. The reason why I'm talking about correction, even though we're making new lows still at the minute, only a couple of days ago, is because if you look at the momentum indicators at the bottom, the MACD in particular isn't looking too great. You can see that the moving averages on that MACD are pointing upwards, which suggests that this decline is actually losing momentum. And you can see the histogram in the middle as well, making much of the same thing. That's known as negative divergence. That in itself isn't a buy signal or a bullish signal. But if you are a bear at this moment in time, you're looking at that and you're thinking this market looks like it could be primed for a correction. The fact that we're in this support zone, and you can even see it on the price charts themselves. They always say price is your primary indicator, and it is. And if we look at the last two times we've made the low, they've not been hugely significant lows. They've not been lows where you've broken lower by another 2 or 3 big figures. They've been very marginal lows before we've seen these corrective moves back. That can be a sign as well that the trend is maybe a little bit exhausted. So that's what I'm seeing right now. I wouldn't be surprised to move back to 107, 108, maybe even a little bit higher in the near term, and that would be conducive as well with other things which we're seeing about dollar corrections. You can see on euro dollar potential correction territory, cable, pound dollar, you can see potential correction as well, and it's really just confirming it on this as well. So if we do see that little move up, I'm not concerned, but I'm looking at those key resistance zones for possible rotation.
So basically selling into higher levels on a technical bounce.
That could be potentially what people would be looking to do if you continue to be bearish on this pair. Longer term, I really wouldn't be surprised to see us going back towards those 100 levels, and at that point it gets very interesting.
So do the central banks then come in and sort of start making noises? Exactly
that. The things like the Federal Reserve won't be too concerned. A weaker dollar when they're raising interest rates makes their life a little bit easier, helps them achieve their inflation targets that little bit easier. The Bank of Japan, on the other hand, there will be, I imagine, growing speculation as we approach that 100 level, the possibility for intervention. The central bank doesn't want a stronger yen. It's already easily, comfortably missing its inflation targets. It's expecting, there's talk that they could be discussing the end of quantitative easing, or the start of the end of quantitative easing maybe next year. This would certainly delay potentially that particular thing. So there is speculation already that coming into that 100 level there may be talks of intervention, but maybe a little early at this moment.
Understood. On that note, Craig, happy Easter to you and your family.
Thank you.